Should I?
Yes, it is. You hit it. Was that right? Did I do that right?
That is perfect. Keegan missed it.
Yeah, Keegan did miss it. She was looking at her phone.
Oh my God.
Gosh, I really hope there's no negative connotation with that because we just went live with it. Anyway, gotta love live broadcasts. Anyway, happy Thursday. Today is a very special day because it's Real Estate Now, February 11th, 2021. It's also a great day for just flat interest rates. We're just going to jump right into it. You know, them good old interest rates.
I'm going to get serious. We're going to talk about interest rates.
I'm trying to get serious. But, long story short, we're staying flat on the interest rate environment. And, you know, there's a lot of mixed signals out there. The Fed just yesterday said that the unemployment is a lot more than what's on the current payroll, and that we're going to have some long-term economic issues, which, I mean, to me is not surprising. If we look at what we just came through, we're gonna be digging out of this for a little bit more. So I don't think.
Did they say how long, Keith, they think we'll be digging out of it?
You know, that's the magic number nobody wants to stake claim to. They're kind of staying away from that. It's very interesting. So we'll see how long it plays out. They did mention their support that they're going to continue to stimulate the economy and support the economy the way that they need to make sure that we don't go deeper into the hole. So, you know, I think more of the same is going to be through this first quarter. We'll really see the rebound once we get through the next round of vaccinations and we get into like Washington. We're still in the midst of phase one, which is very interesting because phase one has like 6 different buckets to go through phase one, which is mind-boggling. I thought phase one was phase one. Here, all you guys go get it. But anyway, so once we get into phase two and more of the general public is exposed and vaccinated, we'll see how quick the economy rolls over and gets back on the upswing. So I think that's really the telltale sign is when we get to that point. But until then, it's just business as usual. They're going to continue to hold interest rates steady. And there's also been a lot of negative interest talk. And I don't think we're going to go there. So I hope not. Negative interest is not good for anybody, especially our economy and the strength of the U.S. dollar. So let's just.
So when you say that, and this isn't a show about negative interest, but you're actually meaning instead of a rate being 2.5%, it actually falls below 0.
Well, yeah. Instead of the Treasury being at right now, it's hovering right at 1%, and there's talk that some economists want us to go to negative interest rate environment to really keep all the liquidity in the market and moving through the economy. And it would just weaken our dollar, in my opinion. So I hope we don't get there. Negative interest at the government level does not equate to a negative interest mortgage payment. We're not going to pay you to buy a house. So I want to be really clear on that. If we did go into negative interest, there would still be a spread between the federal funds rate and the treasuries and what mortgage rates are going to be. We're not selling cars, we're selling tangible assets. So there will be a cost to the money. So it's not like a car where you can get 0% interest for the first 6 years. It doesn't work that way. So
one of the first things we started talking about a year ago was the forbearance programs, which are all from the initial group. They're going to start expiring, right? The 12 months is up. So I think we'll be talking about that over the next few months in a different show. But to me, that's one of the big things too, that we need to be watching for, which programs are going to be extended, what, if any, what kind of help there will be, if any. Otherwise, this April, May, June, July is the 12 months is due for a lot of people.
Yeah, and just to put it out there, and one other interesting facet that I've noticed that some folks are saying, well, their mortgage company's servicer isn't letting me have continued forbearance or what have you. And I'm finding that there's a key point of the CARES Act that hasn't been very well sent out to everybody. The CARES Act only qualifies for Fannie Mae, Freddie Mac, FHA, VA, and USDA loans, right? So if you don't, if those servicers aren't your servicer, it's not a mandate, right? Those banks, those mortgage servicers will work out your mortgage however they want to, right? So definitely now is not the time to be ostrich and head in the sand. You got to go ask those servicers. You got to get really clear on what your options are. So yeah, we will definitely be tracking that topic. But our hot topic
today, what are we doing today?
We're going to talk about an even hotter topic because it's got a time specific. We're going to talk taxes today. We're here in Q1. That means all of us are getting ready to pay Uncle Sam, get a rebate from Uncle Sam, put together our taxes, which are ever annual changing puzzle, right? So every year we get to figure out how our situation is going to put on a 1040 and what that will look like. So to join us today, we have a trusted advisor and somebody that I've known all my life, my brother. You know, I have a huge advantage. Don is my CPA. And so whenever I have CPA questions, he doesn't bill me for them. Thank you, Don. It's more of a family thing. But wanted to bring Don on and just talk about what taxes look like this year. There's been some questions on what we can do with retirement vehicles and all that good stuff. So just want to welcome Don to the show. Welcome, Don.
Thanks for having me. And seeing as how we're on the topic of family, it's the 11th. So our sister actually has a birthday today, and I want to shout out to Jamie. Happy birthday.
Shout out, Jamie.
Happy birthday, Jamie. I saw she was hoping for snow, so hopefully she got some snow.
No, I don't think she got some snow this morning.
No? Maybe
I did talk to her this morning to wish her a happy birthday, and she told me that she dropped her phone in a full bowl of water this morning. So she's kicking that birthday off right.
Hey.
Woohoo.
Awesome.
So, right on. Well, Don, we talked about a couple questions earlier via email yesterday, but let's jump into it. Tax time is upon us.
Yeah.
Right now, sitting at February 11th, corporate taxes have to be in. Is that correct?
So pass-through entities, their deadline is the 15th of March. So your S corps, your 1065s, anybody who's a anybody who's a true tax-paying entity, for the most part, the general rule is April 15th. That'll be your C corps, and 1040s, your personal taxes.
Gotcha. Awesome. So there was no. Did I hear rumor that there was a kickback on when you had to file your taxes, or was that for 2020? Was that still?
That's so 2020, Keith. That was so last year, or at least, or at least there is currently no plans to extend the deadlines. Not saying that there won't be a change, but as of right now, status quo.
Gotcha. Cool. So start filing. So is the IRS open to take personal taxes now? Maybe that's what I heard.
Yeah, so there was a delay because of the new updated kind of tweaks to the tax law at the end of the year, where the IRS had to prepare and get their software ready. So they didn't accept returns, specifically 1040 returns, until just recently. And actually, I got my first acceptance 2 days ago. So we're off and running.
Wow, okay. It kind of sounds like the CFPB when they want us to do changes in the mortgage industry. They're like, yeah, so how about March 1st? Could you do that? Okay, we'll try. But anyway, so everybody's locked, loaded, ready to go. Go file those taxes is what you're saying.
Agreed. And so with that, we're going to head and move forward to, did you lose me?
No, we can still hear you. Go ahead.
Okay.
You're just a little late.
We would go ahead and move forward on filing the tax returns as normal, and get your tax documents to your professional and keep on moving.
So I'm sure the next question, with the delay in being able to file, people are going to say, is there going to be a delay in getting our refund back? Have you heard any questions around that?
I haven't heard much rumblings on a delay in payment, and we'll see what the real world says when it comes time. You know, I'll tell you in 2 or 3 weeks when my first direct deposit doesn't come through.
Right.
Yes. We got
a question from Deb Starr. Hey, Deb, if a person received interest income on a mortgage note, when does the 1098 form need to be delivered to the IRS and payee? That's a good question.
So typically those are done in January, and then the IRS needs to receive them by the end of February, from my recollection. I don't file 1098s on the regular, so I'm not super versed in that realm. So, but the general rule is you should have them already.
Yeah, 1098 is the mortgage interest proof that you paid
Absolutely.
mortgage interest. Yeah, okay.
Correct.
So for all you mortgage holders out there, your mortgage servicer should have issued that. I know a lot of them are pushing them online. And I know when I got mine, there was a very specific note on the service. So Loan Depot has my loan, big shocker there. But when I logged into our portal, it says 1098 may be delayed due to mail backups. So mail is still being delayed to some places. So just that may be a better way to go about it, is log onto your servicer's website and see if your 1098's up there.
For some reason, I thought people had an extra 30 days this year to deliver everything. And maybe that's, to your point, Keith, there's some delay.
Maybe.
Not just mortgage statements, like everything. I thought there was a 30-day delay.
Possibly. So let's talk about, I mean, Deb Starr set this up perfectly. We did want to talk about deductions. And, you know, one reason why people buy a house is the mortgage interest deduction, which tell us a little bit about what that deduction is and how applicable is it in today's market, Don?
So mortgage interest is very interesting in regards to, we're in a transitionary period between the 2017 tax law update. So if you previously had a mortgage that you had prior to 2018, technically 15th of December on the day 2018 for drill, you could potentially deduct mortgage interest on acquisition of a home up to $1 million. So the interest that was generated on $1 million loan, you could deduct all of it on your personal tax. And then equivalent, and also on top of that, if you had a secondary equity line of credit that you used for whatever you wanted, for buying a car, doing whatever, going on a trip, you could deduct up to $100,000 of that interest and also put it on your tax return as a deduction. So the tax law changed in 17. So now acquisition is only $750,000 of interest, that of a loan amount where you can have interest deducted from it. And the equity is gone. So if you take cash out at any point in time, you will, in theory, not get any deduction for the increase of loan amount.
Even if your original loan amount was under the 750, so say it was 400 and you took 100 out, does that count?
Correct. So let's just say for drill, I bought a $400,000 house in your scenario, and then I paid it down to 300, and then I took out a new $400,000 loan. I still lose that $100,000, period. Because I paid down the original loan that you used to acquire the house.
Okay.
Gotcha. So that's a pretty detailed 1098 then? Is that how that would show up? How would a taxpayer know what they should be qualifying for and what they shouldn't be qualifying for?
Well, this is where your tax professional comes into play, because there's a date that usually is on the 1098 that says when your loan started.
Okay.
And when it originated. And with that being said, the analytics are such that if we have interest over X amount, if normal interest rate, the IRS will kind of flag you as you're taking excess interest. And then also there usually with that comes a statement of what the loan amount was at the prior beginning of the year.
Okay.
And so it gets issued that. And so every year those 1098 and the IRS will see that we have either income loan amount, we've paid it off, or what have you. And so with that, your tax professional will have to use those same analytics to keep inquiring about your situation, probably ask you for a closing statement for your refi, and then we'll have to prorate the interest accordingly. So that's where you can get in trouble if you're going to be under audit.
Wow.
So in short, hire a good professional.
Yeah. Amen.
So if we're talking about audits, everyone working currently probably at the home office, which in the past might have been a red flag to call out a home office. But now we have, to your point, Don, before the show started, I have 3 kids schooling online right now. I'm in a home office. They have mini offices set up all over the house. What are we allowed to write off this year when your house became a school and your office?
Well, that really truly depends. Are you a W-2 employee?
I am, yes. If we're talking about me, yes.
You're toast. You don't get any deduction because the 2017 tax law, the 2017 tax law eliminated employee expenses on your own personal return for those that were not reimbursed. Yep. So now if you are going to claim it on a Schedule C, i.e. you're employed by yourself, that's a little bit different story, where we can take a simplified method of square footage and overall footage of the office that is being used solely for your business. And that is $5 per square foot of the office. And so with that, we also going to do an expanded method where we prorate all of the expenses of the house and then allocate them to the square footage ratio of your office. So there is definitely some mechanics to that particular situation. But the general rule is that if you're employed by somebody else, you're toast. You're dead in the water.
And what about?
Is there any carve outs for a treehouse?
No treehouse carve outs, Keith.
It's $2 per square foot, Keith. $2. So nothing for kids schooling at home. Not computers parents bought. None of that kind of stuff. Extra school supplies or Wi-Fi. No one can write off any of whatever they had to do to get through homeschooling.
Sorry about it.
Got it.
Yeah. And Don, I know it's speculation, but those are all points that are being talked about and discussed right now in the new CARES Act 2 or whatever they're going to call it. I mean, those wouldn't have impact in 2020, right? They would only be impacting our 2021 taxes.
Correct. I mean, they could prorate it, and that would just cause a bunch of headaches. Or sorry, backdate it, and that would cause a bunch of headaches. But the facts is that this one, I believe, is going to be more prospective as far as that's concerned. And
Gotcha.
And nowhere are we going to get a lot of relief for 2020 per se is my brief reading and such. And to be clear on the 1.9T package that they're going to try to pass, I haven't done a great deal of research because it's just so fluid right now. We don't know what's going to stick and what's not.
Yeah, lots of good stuff there. So I wanted to also talk about, we're mortgage and real estate shows, so we talk about other deductions that homeowners have, and that comes in the form of our ever rising property taxes, right? So can we do it? I hear a lot of stuff out there that people come to me and say, oh, I heard I can only deduct my owner occupied. I can't deduct my non-owner occupied, my second homes. What can you, when it comes to real estate taxes, what can you deduct?
So you can deduct taxes on your properties, specifically those that are not being rented. Those would go elsewhere on the tax return. But a typical first home, second home situation, you would be able to deduct your property taxes accordingly. Keep in mind that the itemized deduction for taxes is now limited to a maximum deduction of $10,000. No matter if you paid hundreds of thousands of dollars, you're only getting 10. And that includes if you have sales tax, like state of Washington is here, we would get a sales tax deduction, and then that would be in the same bucket as your real estate taxes. So there's going to be an issue with that. So you're definitely going to take a haircut on the real estate taxes if you're paying exorbitant amount. And then the same thing applies to a state like Oregon, where they have income tax, where the income taxes that they pay also go in that same bucket, differently from Washington, because we're sales tax, obviously. But it definitely affects the deductibility of your real estate tax. You will definitely be limited to 10 grand. And that's going to be about the end all be all of that.
So that tax bucket really turned into any other tax that's not federal tax can go into that bucket, not to exceed 10 grand.
A little general, but yeah, for the most part, yeah.
Okay. Interesting.
So what about the people buying a house now, like who bought a home last year? What points can they write off?
Oh, points are points are deductible, just like they are mortgage interest, and they're treated as just prepaid interest with a carve out that allows them to deduct them year one instead of amortizing them over the life of the loan. So that's not changed.
Gotcha.
And so if you pay points in a refinance, that's a different story. We'd have to allocate those throughout the term of the loan.
Oh, really?
Yeah.
Good to know. Good to know.
And that's also origination discount, both. Doesn't matter what kind of point.
Stacy, can you repeat your question?
For points, is it both? There's two types of points in mortgage, right? Origination and discount. So if someone were to do a refinance, is it any kind of point? Is the tax deduction?
Typically, there's some arguments both sides, but typically we try to encompass if it's going to be true discount, that's what we're going to be predicated on. So structure your deal accordingly. Some people are more aggressive and they take the stance of taking the origination as well. So I'm not one of them. I'm true for paying points. We're paying points for the interest rate.
Discount point by definition is a cost to buy down the interest rate of a mortgage loan. Right?
Correct.
So you're in essence prepaying the interest associated with that lower interest rate. So so that origination runs that gray area, which I think is a reason why you see a lot of the lenders out there have moved away from an origination and just line item all their different costs. So, so there's always that should I stay or should I go question. Like people like, should I itemize and put it all together, or should I just take the minimum standard deduction? Because that was a substantial difference coming out of 2017, was it not?
Correct. The standard deduction was increased to $24,000 at that point in time, and it's gone up. Cost adjustments every year, and so if you're not in the neighborhood of getting over as a married couple, 24,800 in regards to your real estate taxes, your medical expenses that count, your interest on your mortgages, and then charitable deductions, you might as well not even worry about it. If you can't get to the 24,800 hurdle or the 12,400 hurdle if you're single, it's going to just be waste of your time, really.
Gotcha. Just
you might as well just take it. Absolutely.
Push the button.
And it's going to be cheap, and it'll be cheaper for you because then your tax preparer doesn't have to continue to process that paperwork and try to do the analysis. If you already know, you might as well save them time. It'll save you money.
Gotcha. So let's talk a little bit about our landlords out there. How does what guidance do they have with the CARES Act? There was a moratorium on evictions, all that good stuff. So when they go to look at these rent rolls and what have you, is that money that's accounts receivable? Is that revenue that they get this year? How does that look for them filing their taxes?
Yeah, so typically I'm going to stay in the realm of small landlords, someone who has 3 or 4 properties in their active or less. So typically those people are cash basis taxpayers. So if they receive cash, they don't pay the cash. It doesn't go on their tax return.
Gotcha.
And so it would be the rent forgiveness or deferral would just simply be a reduction in revenue for that activity, that rental activity. And same thing with if they were lucky to have forbearance on a loan that they pushed off into the future, it would just be a reduction. They wouldn't have paid the interest, therefore they wouldn't get the deduction. And so that would be an area in which you potentially could have a situation that would be either advantageous or not so advantageous, the way you structured the beginning of your payment cycle again when you talk to your bank, because it could be an increase in interest. It could be you have to pay all your interest right now. It could be a myriad of things. And so that's what you need to be very mindful of when you are talking with your bank.
Yep. Yeah, we alluded to that a little bit earlier today. So, you know, I know I've asked you the question, and I think there's still a lot of questions with regard to investment vehicles, retirement investment vehicles, 401ks, and what the CARES Act is allowing people to do with that money. How is that going to impact their taxes? Like, I think you can, correct me if I'm wrong, you can pull out $100,000 without a taxable event as long as you repay it over the next 2 years, 3 years. Did we lose you, Don?
Well, there's definitely that carve out where you can take out. Say, are you here? Can I hear you?
Yeah,
Hello?
I hear you.
Can you hear me? The magic of digital. No, there is still that there was that carve out in 2020. Sorry, anybody who wants to do it in 2021 because it's currently not on the books. Where you could take out $100,000 from a qualified plan, and you would then be able to. There's a few different ways to do it, where you could have a tax deferred or a zero situation for that particular withdrawal. That the 10% penalty for early withdrawal is on those funds, and then you can do a couple different things. You can either claim of the retirement funds that you pulled out on your tax return this year. And then if you repay it over 3 years, you could then go back and amend and get your money back that you paid the taxes on.
Oh, gotcha.
You can prorate it over 3 years as far as the income is concerned. And then as you pay it off, you would then claim less income as you go along. And then you could take a credit for later years for taxes paid. And then so those are like the two most common ones. Now, I haven't dealt with it yet, but I know it's coming, and I'll have to do the major research on how the mechanic of it works when it comes to my clients. But they'll have a couple of choices, and they need to talk to their preparer about it.
Yeah, I just want to circle back. You said the 10%, you glitched out there a little bit. It's still applicable, the 10% early withdrawal, or it is not?
No, sorry about the technical issue in that regard,
Yeah,
but no, the penalty has been waived for 2020 withdrawals in that regard.
Gotcha. Awesome.
So what they wanted to do was they wanted to allow people to have access to money and not put a hurdle in front of them, such as that. They wanted people to have funds so that they could keep the economy going and live and not completely be, SOL.
It gets back to what I always say: liquidity is king. You got to stay liquid. If you're not liquid, you're in trouble.
Yeah. So, specifically, I mean, I know I have a client that has taken those funds because of the fact they needed a new roof on their house, and they were out of work, and it was perfect situation for them. And I said, go for it. We'll figure it out when it comes time to file. But it definitely falls under that. It's a hardship in this time of COVID. So we did it.
So we only have a few minutes left. What do you have? Do you have any top 3 advice to give out to our viewers? Any changes happening that they should know about?
There's not a great deal of update that we can go into a great deal of detail right now, but there's a couple changes potentially for the 1.9 trillion Biden package that we're talking about. Is that there might be some potential landlord relief coming with that package. It's not completely codified yet, but there's slated for roughly 30 million of small landlord relief, and I don't know what that looks like yet because obviously it's so new, but there's that's coming through. And then I just want to reiterate to anybody who's buying a new rental property, there's definitely a situation in which I would recommend potentially having a cost segregation done on your house so that you can take accelerated depreciation on those fixtures and other items that are not part of the house per se. They're lesser lived items, and therefore they can be depreciated quicker, and that'll help them with their taxes.
So can you give an example of one of them might be?
Yeah, so you'd break the house up into systems such as, the roof, the structure itself, the plumbing, and then like the fixtures, the countertops, the sinks and such like that. Those would be something that we could be able to depreciate quicker, especially if they're not integral to the minimum requirements of the house.
Got it.
Nice. Well, just a shout out from Carla there. Carla, thanks for tuning in. It is great information. And Don, thank you for coming on the show. I appreciate it so much. I'm sure you're busy as all get out.
Yep.
Tax time. So.
No, thank you for having me.
Absolutely. We'll catch you next go around, and enjoy the afternoon. Get ready for the snow. Get ready for the snow.
I'm ready, baby.
Right on. Catch you later. Well, there you have it. Don't be taking out that money from your qualified plans right now, because 2020 is over, people. But
yeah, it's so
definitely
much information. I mean, I think it just really shows how you need to have an expert. To me, like,
yeah.
I don't know. I know there's so many people that just file online, and great, more power to you. But just there's so many changes, and it's so complicated. I would want to work with Don.
Yeah, absolutely. And I'm very blessed to have a CPA as my brother. So, right on. Yeah. Well, look forward. Thank you all for tuning in, and look forward to seeing you guys next week here on Real Estate Now, and we'll kick it off Thursday at 10 a.m. Until then, have a